Good morning, Chairman Waters, Ranking Member McHenry, and the members of the committee. Thank you for holding this important hearing and for the invitation to Better Markets to testify. We have already heard many of the market structure and regulatory issues addressed by this hearing are complex, hotly disputed, and often difficult to understand. But it's important to remember that they directly affect the economic activity and growth of the country. In fact, these issues actually impact how businesses form, grow, and create jobs, or not. And that's what is really at stake and why everyone has a stake in these issues. Simply put, the purposes of our financial system and markets are supposed to be a wealth creation system for the many, not a wealth extraction mechanism for the few. And that's why the work of this committee is so important to the lives and livelihoods of all Americans. However, because of the limited time and the format for hearings like this, many of those issues won't be able to be adequately covered today. And that's why the written testimony I've submitted is so long. It covers many of the issues extensively and in detail. It is intended to be a resource to you and your staffs long after this hearing. While all of that written testimony is, of course, fascinating and well worth reading, I want to draw your attention in particular to the attached Appendix C. That appendix has 7 slides that I created to visually show how payment for order flow works and how retail investors do not get best execution. Indeed, as I show in those slides, retail investors are virtually guaranteed to get the worst execution. That written testimony and those slides demonstrate that the markets are not a level playing field. They are rigged to advantage the sell side against retail investors, pension funds, and the buy side generally. Put differently, these markets are too often a wealth extraction mechanism to enrich the few at the expense of the many. That's detailed in my written testimony. I want to make just 2 quick points before my time is up. First, our markets may be the envy of the world today, but that is not preordained, guaranteed, or destined to always be the case. It is only because people believe our markets are relatively transparent, well-regulated, and policed. That's due to the hard work of legislators like yourselves and regulators like the SEC. That work has engendered faith and confidence in that our markets are fair and relatively free of fraud. That confidence underpins our markets. Lose that, and our markets will not function. If they don't function, then our economy will be hurt. Jobs, growth, and living standards are at stake. That, unfortunately, is the precipice we currently stand on. While the world may be envious of our markets, poll after poll shows many Americans are losing faith and confidence in our markets. And that's why the many issues raised by the GameStop frenzy are so important. If not properly addressed, they will happen again. And if they do, they will crush investor confidence, then our markets, then our economy. Remember, a growing, thriving economy is the very purpose of the markets. Capital allocation and formation to fuel economic growth, rising living standards, decreasing inequality, and making the American dream available to more people. That requires a level playing field, full and fair price discovery, and serious investor protection. Anything that interferes with that erodes investor confidence and should be eliminated. That's why payment for order flow and the many other wealth extraction activities and conflicts of interest revealed and highlighted by the GameStop frenzy have to go. Second and finally, Congress must remain deeply skeptical of the disingenuous arguments that retail investors have never had it so good. While that is arguably true, it is not attributable to payment for order flow. The actual causes of increased market access and narrowing spreads over the last 25 years are due to technological innovations, cost reductions, the introduction of electronic trading, the implementation of decimalization, and other elements of the regulation NMS framework. In fact, without payment for order flow and the other intentionally created complexity used to disguise the wealth extraction activities, retail investors would be significantly better off today, and investors and public confidence would be higher. That could be the foundation for a virtuous cycle where more people invest, more capital is available, more businesses are formed and funded, more jobs are created, and economic growth increases and broadens. benefiting all Americans. That's our collective goal. Thank you, and I look forward to your questions.
First, are you concerned with the gamification of the Robinhood app? And second, do you believe Robinhood's disclosures are properly balancing the potential downside risk of investing, including the risk of substantial loss and the more enticing claims of profitability and the ease of trading?
Thank you for your question. And yes, we should all be concerned about the gamification of the Robinhood app. Its primary function is not to get people to invest, it's to get people to trade. And it wants people to trade because the more people trade, the more payment for order flow it receives, the more revenue it gets, the richer they get, and the bigger the IPO that they've got in the pipeline coming. That's what gamification is about. And the Professor Bogan has very well stated the academic literature about so many aspects of the app driving people to thoughtlessly engage in trading rather than thoughtfully engage in trading. One of the big problems we have here is, unlike Mr. Piwowar, we do not have PhD economists applying economic principles here. We have a game-like mechanism that's meant to actually cause people to drop their defenses, to not think at all about losses and risks, and to only think about gains in trading. And everybody should worry about that.
As we consider issues associated with gamification, what type of reforms would you recommend?
Well, I think that one thing that should be done, and Professor Brogan again has talked about this, is the aspects of these apps that actually are scientifically designed to hit the endorphins of the trader, which is to say to short circuit and cut off thoughtful processes that people engage in, balancing risks and rewards, balancing the need to do something versus the reflex to do something because something unconscious has been engaged. And indeed, as Sal Arnott showed in his testimony, if you look at the other platforms, they actually thoughtfully present material on, for example, options and the risks of options. You don't see that on the Robinhood app. And indeed, on the Robinhood app, do you know one of the most often asked questions, according to an article I read, on the app is, what is a stock? There's another frequently asked question is, what is the S&P 500? So you have a base of customers with extremely low knowledge who are being intentionally activated unconsciously to trade more and more often for the sole purpose of enriching Robinhood.
Thank you. Mr. Kelleher, during last month's hearing, I also brought up the important issue of short selling. While I said at the time and continue to understand that short selling has legitimate purposes, I also said that too often I have seen the strategy used against working individuals and families. First, against the people of Puerto Rico, and now here with the GameStop craze. Currently, large investors, including hedge funds, must disclose their long positions when they own 5% or more of a company's share, but not such disclosure is required for short positions. As we consider reform, is this type of disclosure for short positions something you will support?
There absolutely should be greater disclosure for short positions, both on the institutional investor side and on the broker-dealer side. And that disclosure should be increased in terms of frequency and particularly in terms of content. There's a great deal of synthetic shorting happening in these markets with total return swaps and other synthetic products that actually disguise and understate what we even now publicly know. So across the board, in terms of the actual entities, in terms of the timing, and in terms of the content, disclosure should be increased. And it should actually be pretty well studied. But regardless of the outcome of that study, we need more information to the market so that people can act more informed.
Thank you, Madam Chair. Thank you, Mr. Kelleher. I yield back.
Mr. Kelleher, thank you for pointing out that just saying investors have never had it so good is hardly an answer. I'm not going to send a love letter to T-Mobile because my phone is cheaper and better than it was 20 years ago. I expect to get the lion's share of the benefits of technology. Now, during the last hearing we had on this subject, I asked the CEO of Citadel, Ken Griffin, whether the customers of Robinhood get the same trade execution quality as customers of Fidelity, a broker that does not accept payment for order flow. Mr. Griffin twisted, turned, filibustered, did everything to avoid giving me a straight answer. That's why I want to commend the CEO of his, perhaps his number one competitor, Virtue Financial, who went on CNBC and said, and I'll quote, overall, though, during the course of a month, we will provide more price improvement to Fidelity than we do to Robinhood. Now, of course, Fidelity charges 0 commissions for online trades, but Fidelity does not accept payment for order flow. So clearly we could have no payment for order flow and 0 commissions. Further, payment for order flow offered by market makers was banned in the UK almost a decade ago, and their markets continue to function well. Is there any reason the U.S. shouldn't take a similar step of banning any payment to brokers when they're acting as an agent for directing their order flow?
No, Congressman Sherman, thank you for your question. It can be banned and it should be banned. It does not mean that the intermediaries will not be well compensated. They will still be well compensated because they can be compensated on a spread. And what it would do if you ban payment for order flow, it would have the additional benefit of driving a lot more trading to the public markets, which now are less liquid and have less trading because so much of it is being skimmed off, about 47%. And we detail this in Appendix C of my testimony. 47% of all the trading is flowing into dark, unregulated, low investor protection, non-disclosure markets by these internalizers who are using legalized kickbacks and payment for order flow to executing or to retail brokers like Robinhood. And everybody's getting rich, but that money's coming from somewhere. And where it's coming from is the pockets of retail investors.
And I'll point out that even if I get a good execution of my trade in one of these dark pools, the country is deprived of information about that trade that would be available if we traded on a market.
Exactly.
I'll just also point out that we live in a strange world where some people get best execution and some get price improved best execution. And I yield back.
I want to start with overselling a position. So, Mr. Kelleher, in the previous hearing, and I think Mr. Luke DeMeyer was right on point, and I really want to understand this area. In the previous hearing, I asked Mr. Plotkin of Melvin Capital whether his firm was ever naked short selling on GameStop stock, and he said, no, the systems won't even allow that. That would be impossible for us to do. Yet, according to a report from Bloomberg Government, which analyzed the SEC data, $359 million of GameStop shares failed to deliver or be covered, suggesting many of the shares had been borrowed more than once. I think Mr. Plotkin's testimony was truthful, but can you explain what's happening when so many shares fail to deliver?
Sure. Thank you for your question. The current regulation only requires broker dealers to have a reasonable or institutional investor have a reasonable ground to believe the security can be borrowed so that it can be delivered on the delivery date. So it's a reasonable belief. Now, I don't know about Mr. Plotkin's system, although it sounded like a pretty good system when he said it, which is he says unless his firm has identified, in fact, the security and to have it deliverable, it doesn't even allow them to short a position. But that's not actually the law as I understand it. As I understand it, it's a reasonable belief. And people can have a lot of reasonable beliefs. And we have massive failures to deliver of GameStop stock in January. So not only do we have a short position that exceeds about 140% of the available float at the time, but then subsequently we have a massive failure to deliver those securities at the time of delivery. So, and I'm sure, as Mr. Piwawar said earlier, the SEC is looking carefully at this, and I would expect their report to provide us with a lot more information. But as of right now, the publicly available information certainly indicates that there's a very high likelihood of some abusive short selling by somebody.
All right, so let me ask you this. So, I mean, Mr. Luchtenmeyer talked about sales 140% of existing shares. I mean, how does that happen?
Well, in the securities lending business, it happens because somebody lends a security to somebody who lends it to somebody else to lends it to somebody else. It goes by the technical name of rehypothecation. And what it does is you have this cascade effect where you, in fact, have the same security lent out multiple times. And then arguably you have short sellers having a reasonable belief at a period in time that that's the security that they could reasonably deliver at the delivery date. The problem is that that security has now moved to somebody else who has a reasonable belief that that very same security is the one he can deliver or she can deliver. And so the way the system works now, it's almost a house of cards. And I agree with several of the witnesses who said one of the things that needs to be understood and disclosed at a much more granular level is not only the activities of the short sellers, but we need to have greater disclosure and granular knowledge of what's happening in the securities lending market.
It's very, very clear what happens when retail investors trade a lot. Mr. Kelleher, in terms that the folks watching at home can understand, what happens when retail investors trade a lot?
They lose, and they lose consistently. And they lose because they're paying more for every single one of their orders because we have a order routing system that is intentionally complex and designed to extract the maximum amount of wealth from the retail investor. And
But
that's
it's not
why
just that, Mr. Kelleher. I'm sorry, let me interrupt. Thank you. That's what I thought you would say. But it's not just the structure of the system, right? When you look at the literature, retail investors lose because of a whole series of human biases because they don't have teams of PhDs studying the stocks that they're buying, right?
well, absolutely. You know, it's like saying that let's send a little local little league team up against the New York Yankees or the Boston Red Sox or the LA Dodgers. Frankly, you have these institutions that have maximum informational advantage, maximum technological advantage, maximum sophistication. They get to use all of that they have paid billions for the purposes of extracting wealth. The
Right.
retail
And
investors can't compete.
Mr. Pivovar's not wrong, right? I mean, there's going to be a distribution curve here. There will be some people who get lucky or who are at the narrow end of the curve or who do win. But on average, retail, again, for the folks at home, the more a retail investor trades, the less well they're going to do from an investment and saving standpoint, right? There's no ambiguity in the literature about that, is there?
None at all.
Okay.
Mr. Kelleher, would you disagree with anything that you just heard from Mr. Arnott?
I know he's exactly right. And in fact, I would go a little bit further. The Congress doesn't have to ban payment for order flow. The SEC should take the position right now that payment for order flow violates or facilitates the violation of the best execution duty. We know for a fact that today, about 47% of all trading is happening off exchange in dark, unregulated markets. None of that flow goes to the public exchanges. And we also know that the trading in those exchanges get worse execution than they do on the public exchanges. And what has happened over time is this artificial construct of best execution based on what's called the NBBO, the National Best Bid and Offer, on the exchanges. So they're claiming, and Mr. Tenev said this last time, we got price improvement. We do great for our customers. According to what? It's according to the NBBO, but the NBBO only reflects about 40% of total orders. And the least liquid market that there is at the time right now, which is the lit markets. And Mr. Arnott is right, it doesn't include odd lots, and it doesn't include, by the way, gray market, hidden trades. also the 20% of the market. So what they're saying is we do great things. You can look at this. We do price improvement. We do better than the NBBO. But both of those benchmarks are misleading, if not intentionally false. And the SEC should take the position that that violates the duty of best execution today. I don't think there's any circumstance under which Citadel Securities is not a systemically significant firm and FSOC should investigate it. In addition, the SEC should not exclude companies like Citadel from Regulation SCI, which is supposed to have resilient infrastructure. And the SEC inexplicably excluded broker-dealers like Citadel from that regulation and those requirements. So there's a risk on the infrastructure side, and there's a risk on the systemic institution side for anybody to say, if Citadel shut down today, even for a day, that means 26% of all U.S. equities volume in 8,900 listed securities would stop. It executes 47% of all U.S. listed retail volume. It represents 99% of the traded volume of 3,000 listed options. To say that the system would work perfectly fine if all that evaporated today and competitors come into the market, that may ultimately happen, but until it ultimately happens, you're going to have a systemic event. And to deny that is to deny reality.
Kelleher, with 30 seconds left, is there anything you'd like to add to anything that Mr. Arnica said?
No, he's exactly right. I mean, frankly, the SEC should consider taking fraudulent action for people who claim price improvement off of NBBO because it's at best misleading, if not a fraudulent claim, and knowingly so.
One of the things that I would like to hear from you, if you agree, yes or no, do you think the current regulation of private equity meets your standard of, quote, transparent, well-regulated, and policed? Yes or no?
Absolutely not.
Yeah. Is it true that private equity firms don't have to share data on their climate risks?
Correct.
How about how they treat their workers and their portfolio companies?
Not that I'm aware of.
Isn't it true they don't have to share data on whether they're promoting racial equity and diversity?
They do not. They're private companies. The disclosure is almost zero.
That's right. And even though they control more than like double the number of companies publicly traded on the US. I mean, it's double. It's 8,000 companies in the United States. So I thank you for that, Mr.
Kelleher, people talk a lot about how retail trading is democratizing finance and helping the little guy. But from your testimony, it seems like the current system of retail trading does the opposite. It rewards huge firms that can handle lots of trades, and it rewards high frequency trading. Do you think that payment for order flow model of retail trading actually entrenches big players?
It does. And the fact that those big players have almost no disclosure obligations and very few regulations makes it even worse. And one thing that hasn't been brought up that is a major problem, which is the Citadels of the world are a big part of the shadow banking system. There's a lack of transparency, there's a lack of regulation, there's a lack of oversight, there's a lack of accountability. All of that enables secret wealth extraction by the big dogs in finance, all at the expense of the retail investor and the retail trader. And that all needs to be looked at and changed. But the one thing we know for sure, and Sal talked about this earlier, the retail investor ends up getting time and time and time again the worst deal. That doesn't mean we're not in favor of more retail investors. We'd love to see more retail investors. We just think it should be a level playing field. We think they should be treated fairly, and they should, right now, they're discriminated against dramatically. They're in a terrible position and being picked off, and they shouldn't be. So we're not against democratization. What we're for is level playing field, transparency, accountability, and fairness. And that will increase confidence, and that will increase retail investors.
Mr. Kelleher, would you be interested in offering some comment on this discussion?
Yes, I agree that the upstream disclosure increase for the securities lending part of these activities needs to be addressed, either through legislation or through regulation. That's clear. But we also need increased disclosure of the short activity that we currently have, separate and apart from what we need for the securities lending. But for the short activity, we need greater disclosure on the timing and the frequency, or the increased disclosure on timing and frequency of that disclosure. We need to expand the firms that are subject to the disclosure. It needs to cover hedge funds, broker dealers, and everybody else engaged in those activities. And it has to expand to cover all the products that are being used. It's not just puts and calls. You've got equity derivatives, total return swaps, synthetic exposure of all sorts of ways. So multi-layered increased disclosure and transparency will benefit everybody in the market.